You can see here that is a very important topic. So we use duration a lot today. We might use duration within the next few weeks too, but we use duration a lot when we come later on to banks. That's the reason why it's really important that you have an understanding about duration. Now, duration can look quite scary if you read it up in the book. There's this massive formula how to calculate duration. You don't need to know the formula, and I don't expect you to calculate difficult durations either. But I expect you to get a good intuitive understanding what duration means. And that's the reason why we spend some time on it. Duration is used to assess interest rate risk. So remember, we want to see how strongly the bond price is reacting to changes in interest rates, and duration is super important for that. If you want to read up on that one, Lange, Saunders and Millen, that's $30 textbook with the 4 chapters, has the best summary of that one, but you should not read the whole chapter because that chapter already starts talking about banks, and we do banks in just before Christmas. So only read pages 171 to 182. And don't worry too much about the math. If the math is getting too scary, the math that we do here on the slides, enough. Good, and you don't need to calculate yourself. I've got a little Excel sheet for you. So we've got these different bonds here, and we can calculate the duration. So the duration, how long do we have to wait on average to get money back? Well, for the zero coupon bond, it's very easy. We don't get any money back before 10 years. So the zero coupon bond has a duration of simply 10 years. Done already. Now this one is a bit harder because we get some money back after 1 year, some money back after 2 years, some after 3, and so on, so on, so on. And most of the money we get back after 10 years. So it's a bit tricky to say, well, is it 2 years, 5 years, 10 years? And Macaulay came up with a very smart formula, this one here, to calculate the duration, which is in this case 6.76. And the best way to see this one is basically again in an Excel sheet. So what's the idea here? The idea is a little bit like a scale. We want to see how long do we have to wait on average to get money back. Let's make a simple example. Let's just say we have 2 cash flows only. One cash flow, we get half of the money back after 1 year, half of the money back after 3 years. Now, if you have to guess what the duration is, what would you guess? Half of the money 1 year, half of the money 3 years. On average, we have to wait 2 years. So that's roughly the intuition of duration. It's just getting a little bit trickier because what we're doing here is we're taking the present values of the payments. So we have here the coupon payment, and in this example here it's the coupon payments. Let me change them. Let's do it like we had there. 10%, 110, 10. So it fits the slides a little bit better. So we get $10 back after 1 year, but we calculate the present value of these $10. So this is simply discounted by 10%, then we get $9.09. We get also $10 back after 2 years, but because we have to wait 2 years, the present value of that money is less because we're discounting it for 2 years. It's just 876 and so on. So we take all these present values, and you can see here if you have to wait for 9 years, for $10 the present value is only 4.24. And what they're doing then is they're saying, okay, we're comparing not the absolute terms here, 10, 10, 10, but we're comparing the present values. And we take that one as a percentage of the present value of the total bonds, of the price of the bond. So 9.9% of the present value of the bond, of the price of the bond, we get after 1 year. 8.26% of the bond we get after 2 years, and so on. So the 9th year payment is basically 4%. So what they're saying here is, well, we have to wait for 9% of our money for 1 year. So we just multiply it with 1 year. For 8% of our money, we have to wait 2 years. So we multiply it with 2 years. Also here, 8% of our money we wait for 3 years, and so on, so on, so on, so on. So we multiply all these numbers in, and then we get these numbers and add them all up. And then we can see, on average, we have to wait for the money 6 years. Now that's an abstract number because we actually don't get half of the money back at 6.76 years. But this is how we can calculate the average time. I see you're stunned. You don't have to calculate the average time. The Excel sheet is doing it for you. But we play around with it a bit so that you get a good grasp what's going on there. Because the duration, it will turn out, is very important to see how strong the bond price is reacting. And there's going to be a simple formula for this one. Another good way to think about duration, in my opinion, is the following intuition. Imagine it like a seesaw. You get cash flows at different points in time. And you put all these cash flows on a board. And you put your finger under the board and try to keep it balanced. And the spot where your finger is, so that the board doesn't tip, that there's not too much cash flows in one or the other direction, that is the duration. That is the average time. Because here on that scale, we've got time, right? 0 years, 1 year, 2 years, 3 years, 4 years, 10 years, and so on. Now let's just make that experiment. Just imagine a 0 coupon bond. You get all the money back at the end. Time to maturity, 5 years. So the sack of money is sitting at 5 years. Where do you have to put your finger that it doesn't tip over? Five years. Same game if I put the sack of money onto 11 years. Where do you have to put your finger? 11 years. Now I'll make it harder. If I put one sack of money at 5 years and the other sack of money at 11 years, where you have to put your finger then, roughly? Somewhere in between, right? And because the sacks of money here is not the cash flow itself, but the present value of cash flow, things get a bit more abstract, right? That's the reason why we need that Excel sheet. But that's the basic idea. So you can imagine the more we push the present value into the future, what's happening with the duration? Longer or shorter duration? Longer duration, exactly. The more present value cash flows come early on, the shorter the duration. That's the basic idea here. Good, let's play around with this one. So you can imagine this one is all the present value cash flows here that are sitting on that seesaw. And you have to put your finger somewhere. So I would reckon visually you can already see, right? You have to put your finger somewhere around this area. Otherwise it's tipping. And this is exactly what's calculated here too, 6.76. Now let's start changing things a bit. What's happening if I reduce the coupons? So I make the sacks of money that we get early on smaller. What's happening to the duration? Longer duration, right? Let's check that out quick too. So I make lower coupons. Longer duration, 766. And you can see that graphically here too, because we get less and less money early on, the duration is getting longer. Just a thought experiment. Let's say if I let the bond run only for 8 years, what's happening to the duration then? Longer or shorter? Shorter. Let's do that very quick too, so everybody can see it. 0. That's 655. So now we'll make it more interesting. This one is harder. If I increase the yields to maturity, so the market interest rate, and that means that the discount rate here too, what might happen then to the duration? And I thought that's less intuitive, but if you think of this graph, then it becomes more intuitive. So the yield to maturity is also the one that we're using to calculate the present values here. Now if I crank that up, number one, what's happening to all the present values? If I discount by a higher rate, the present values will go down, right? All of them will go down. Which one will go down more? The 1 year one or the 8 year one? 8 year one. So if the later present values go down more than the early present values, what's happening to your scale? Where do you have to put your finger? Where will most of the money be now? Earlier or later? Earlier, right? So it shortens the duration. Let's try that out too. 655 was the duration now. 15, 628. And I find it especially useful if you put in really big numbers, because then it becomes more obvious. 33% yield now. You can see here what happens. The last payment after 8 years in present value terms becomes very, very small because we discount it by so much. While the first payments don't decrease that much. In fact, in percent term to the total value of the bond, it increases. Right? So it shortens the duration. Good, so the intuition, that is important to me, that you understand the intuition. This one with the yield I find personally the hardest. All the other ones, just imagine with your finger. Think of what's happening with different cash flows, and then you can just use your finger in that sense to estimate the duration. Trick question, you've got a 20-year bond with 5% coupons, 6% yield. Is it possible that the duration is longer than 20 years? If the last payment is after 20 years, is it possible that the duration is longer than 20 years? Just think of your finger. So if the last payment is, let's say this one is 20, and you put your finger here, clearly it's going to tip. So the duration of a normal bond is always shorter or same as the maturity. It cannot be longer. There are certain derivatives and artificial financial instruments where the duration can be longer, but not on the normal bonds and not for our class. So if you do some kind of a calculation or you come up with anything where your duration is longer than the time to maturity, that's for sure wrong then. Why did we play around with the duration? Well, I said already beforehand that the time to maturity, the longer the bond runs, the more the price is fluctuating. But we made the comparison between zero coupon bond 10 years and coupon bond 10 years, and we figured out already, wait a second, the time to maturity is not enough to figure out how strong the bond price is reacting. But the duration is enough. That's the beauty of it, because the duration has the following property. If you take the change in the interest divided by 1 plus I, the interest rate itself, so the yield, and multiply it with the duration, we end up with the relative change of the bond price. So we can, with this easy formula, you don't even need the Excel sheet, approximate by how much your bond price will fluctuate. And that's the beauty of duration. It's a very fast way to calculate how much interest rate risk you do have in your portfolio. And later on for banks, we will use it also for risk management. Good example. We have a zero coupon bond. Duration is 10 years, of course, of that zero coupon bond, but it runs from 10 years. And the yield is going up from 10% to 11%. So the yield is going up, the bond price will for sure go down. And the question is by how much? Usually we would have used the Excel sheet or calculate the present value, but we can do it quicker. We can just plow in all the numbers in here. So zero coupon 10 years has a duration of 10 years, of course, so we can plow in here 10. The change in interest rate from 10% to 11% is 1%, but here careful, when you type in 1%, use it as 0.01. So here 0.01. Then divided by 1 plus the interest rate, so divided by 1.1. Press enter, times the duration, 10 years, and then a minus sign, so we get 0.091 is the change in the bond price over the bond price. And if you multiply by 100 and put a percentage sign there, it's basically saying the bond price will plunge by 9.1%. So it's a very quick and easy way to calculate how strongly your bond price will react. The same for the coupon bond. The only difference is the coupon bond, because we get some payments earlier, has a shorter duration. So the duration of our coupon bond was 6.76. So we plow in here 6.76. All the other numbers stay the same. And then we figure out that the coupon bond will decrease by 6.1%. Let's play around with these numbers a tiny bit more. Let's say if I say here the duration is not 10 years of this bond, but it's 20 years. Number one, before you even start calculating, will the bond price react more now or less to interest rate changes? If the duration is longer, the reaction will be, I'm told it even rhymes, stronger, right? So a longer duration, stronger reaction. And you can see that here, just plow in instead of 10, 20. And we can see here straight away, instead of 9.1%, we get 18.2% change in the bond price. Similar here too. If I increase the duration, this one also will react stronger. So that's the reason why duration is so important. Duration is a very good measure for interest rate risk, for how much the bond price will react if we're changing interests. Now, why do I harp on so much about it? This is real data, even though it's not very up to date, would look pretty much the same right now too. We have 4 different lines here. We've got the 30-year Treasury bond price. That's the blue line here. And that must be measured on the left-hand side. So just imagine it's a discount bond for 30 years. So initially you can buy it at, what is this here, $23. Then it's going almost down to $20, up and down. Here it's going up to over $40, right? So a big change, and so on. That's the 30-year Treasury bond price. And the yellow line is a 1-year Treasury bill price. So both of them are by the US government, so you could consider default risk very low. And the only difference here between the two is the time to maturity and hence the duration. Now let's make the first interesting observation here. Both of them are used as discount bonds, so without any coupons. How come that the 1-year Treasury bill is so much more valuable than the 30-year one? Look at this one. The 1-year one is just sitting under 100, while the 30-year one is sitting at around 20. How come? Ask. So why is the 1-year Treasury bill price under 100? Check the biggest weekly changes on the prices and think of what's better for existing bond holders. First thing, why is the 1-year Treasury bill price just under 100? Let's say, for example, it costs $91 here. After 1 year, you get $100 back. What's your percent return? Roughly 10%, exactly. So we just have to wait for 1 year. So basically here the jump from down here till next year we get 100 is the yield to maturity in that moment. So it's the interest rate in that case. There's of course interest rates on the 30-year one too. But here if I invest $20 here, how long do I have to wait till I get money back? 30 years. And how much money do I get back then? $100. So the present value for 30 years is of course much lower than the face value. So that's the reason number one. There was an interesting question here, right? Is it possible that the 1-year Treasury bill is sold above face value? Let's say, for example, at $110. I see some nodding. Somebody says no. Let's start with no first, if you don't mind. Why should that not be possible? Why would you pay $110 now to get $100 back next year? If you lend your friend money, you usually don't give him 110 and say, but you have to give me 100 back next year. Or you want to have 110 plus something else back next year. So that would have negative interest rates. But we will see during this class, even though economic theory would say that should never happen, that doesn't make any sense, currently we're in a funny world where that does happen. But we push the explanation for that one way into the future when we talk about banking, because it has to do with monetary policy and some other things and risks, but nothing that we have done up to now. And it's a very unusual situation that only happened over the last few years. Beforehand, basically never happened. Negative interest rates, that would be. What has been the biggest weekly percentage price change on which security? Price changes are the dotted lines. This one here, right? But how much in percent did it change? In 1 week? 14%. Now just think what that means. We're talking about US government bonds. Are they considered safe or risky? Very safe. 14% jump. Is that typical for a safe asset? That they go up? Well, they not only go up, right? Look at this one here. Minus 10%. 1 week. So make a practical example. I am buying the bond. I'm investing $100 in this bond here and wait 1 week and sell it to, let's say, you next week. It went in between 14% up. So I'm selling my bond now to you at 114. I made $14 plus, 14% plus in 1 week. If you think of that one as an annual return, it's huge. I'm really happy. Now you hopefully it's going up by 14% again. But tough luck, as soon as you bought it, minus 10%. So your bond is going to be 114 minus 10%. I should not do that much in my head. $11.40, right? $11.40 just in 1 week. And it is for US government bonds. But also, does that mean that the US government did something wrong? Did they not repay? No, right? It's all fine with the US government. These are just price fluctuation of the bond prices. Remember, bond prices do change simply because interest rates change. That is the interest rate risk that we talked about. And what we can see here is some bond prices fluctuate a lot. And these are the long-term bond prices because the duration is 30 years. Remember the formula. So the duration is roughly 30 years. So whatever change in interest rates we have, even if it's a small change, you multiply it by 30 because the duration is so long. So the bond price is reacting by a lot. Let's check the 1 year one. So that's the red line. Percentage weekly changes. Hardly any changes. Because the duration is now 1 year. So which one is the safer bond? 1 year or 30-year bonds? 1 year is way safer. In fact, 30-year bonds, if you don't want to wait for 30 years, is a very risky investment because the prices are going like nuts up and down. Right? So if you ever hear somebody going like, buy long-term government bonds, very safe. Well, it's safe that you get your money back at the end. But what happens in between? All hell can break loose. These are huge changes. Just an understanding question. If once you've got the bond, what you're hoping for? That the market yields go up or down? Down, exactly, right? If the market yields go down, the value of your bond will go up. So you can see here, this is a fairly recent newspaper article. And I picked that one up because it actually shows how important all this stuff is that we're doing. So the Australian Financial Review has spoken to Katharina King here, QIC, Director of Research and Strategy, sounds pretty solid. Australia, so the Australian government has issued a 30-year bond very recently at a yield at 3.27, and I've looked it up, the coupons are 3%. So there's 3%, 3%, 3%, 3%, or $3, $3, $3, $3 for 30 years. At the end of the 30 years, you get $100 back. But because the market yield is a little bit higher, 3.275, we already know that the price of the bond will be a little bit lower, below face value. And that's what I looked up to, 96.50. It got sold for in October, beginning of October. And she says 3.27 is an extremely attractive yield, which kind of makes sense. I mean, on the savings account, what do we get nowadays? 2%, 2.5%. So 3.27 sounds good. And Australia has a AAA rating. So surely the Australian government is around in 30 years we get our money back. So there's hardly any risk and it's a good yield. But you have learned already, what kind of risk might you have if you don't want to wait for 30 years? The price of the bond is fluctuating and yields are fluctuating. And the price of a 30-year bond might fluctuate a lot or little. A lot. So there is heaps of risk. interest rate risk. Now let's see what happens since then. I've looked up some more things. The duration is 20 years because some of the money we get back earlier, so it's not time to maturity 30 years, but the duration, so the average weighted thing is 20 years. I calculated that for you, you don't need to worry. Now I want you to check something. What is happening to the price of that bond if the yield in the market goes up from 3.27 towards 3.7? And we've got that formula here. So if you plug in the numbers, you can calculate what's happening to the price. How much will this price change? And that's important to me. So before you even start calculating, the price of the bond will go up or down. If the yields go up, price will go down. So for sure, the math should turn out with a lower price in 96.50. So what do we have? Change in interest rates and yields. So the old yield was this. The new yield is this one. So the change in the yield is 43 so-called basis points. 100 basis points is 1%. And because we don't like to talk in 0.0000, it's easier when we talk in basis points sometimes if you talk about small changes. So the change is 43 basis points, but unfortunately here we have to use the 0 now. So it's 0.0043 divided by 1 plus 0.0327 is the old one. And then the duration is 20, minus sign in front of it, and then we get 0.8 something. And that means basically minus 8%. Remember, I said duration, very important. You won't get the same question, of course, but I expect you to be able to use a formula like this. And I would put that formula on the formula sheet too. Now, 8% loss, if this was true, if 3.27 was the old yield, this is a new yield. Let's check out, right? October 12, 16, that's just like 1.5 months ago, almost 2 months ago. Strain yields. Here, that's what happened. So Catherine, I think was her name, so she said this is a really good yield. Beginning of October, where you see, October here. You should really buy that bond at $96.50. 3.27 yield, AAA Australia, super safe, fantastic investment. But you know that it has a long duration, 30-year maturity, 20-year duration. Interest rates in Australia right now, where do you reckon they go in the future? Up or down? Up. They're super low interest rates right now, so there's a risk that they go up. If the interest rates go up, bond price goes down. A bond with 20 years duration goes down by how much percent? In our example, 8%. Look at this one, from 96 to 88 in less than 2 months. Imagine you're convinced your parents, I've read the Australian Financial Review, we should plow all our $100,000 savings into government bonds, AAA. Much better than the savings account in the bank. Currently the bank is offering you 2.5% or something. Now your parents would not be very happy that their $100,000 became $88,000 in 2 months. Now if that happened to you, what should you tell your parents? Should they sell these bonds now? No, right? Hold on to them for 30 years, we'll be fine. Right? But that's what you see, hopefully, getting out of this one. It sounds like pure theory what we're doing here, but it's very practical. And it's also very important. You can see what a massive impact that has. And I don't make these numbers up. They're real numbers. So we've learned huge risk on long-term government bonds. Interest rate risk. On top of that might be another risk, and that's where we're getting to now.